For years, this chart told a simple and reliable story, but earlier this year, something broke down, and it points to a seismic shift in how investors are feeling about the US economy. The black line is the US dollar versus the euro. When it goes up, the dollar is strengthening, and vice versa. The blue line is the US interest rate advantage over Germany, also known as the rate differential. When this line is higher, it means US interest rates are higher than in Germany and the euro area. They moved together for a simple reason: global money follows yield. So, when US interest rates rise, as they did in 2022, US bonds become more attractive and investors flock to buy them in US dollars. So that strengthens the dollar. That's been the story for years. But in April 2025, that logic broke and these lines diverged. US interest rates remained high, yet the dollar began to weaken. Investors started selling dollar-denominated assets, willingly giving up a higher return. And this divergence could be an important warning signal. There are a few compelling reasons for it, and it's a signal that the market's focus has shifted from seeking higher returns on cash to uncertainty about tomorrow's economic risks. This chart shows one of those risks: the US debt crisis. The debt to GDP ratio now stands at 124%. That means that US public debt, which tallies up to $36 trillion, is bigger than the entire American economy, and has been for years. This is why in May, Moody's downgraded the US government's credit rating from AAA to AA1, reflecting real fears about the long-term sustainability of the US debt burden. This calls into question how risk-free US treasuries actually are, and is likely a big factor pushing some global investors away from US bonds and into foreign markets. But not everybody is fleeing the US bond market, and this chart proves that. This line shows foreign ownership of US treasuries, and this other line shows that as a percentage of US public debt. As you can see, beginning around 2015, the growing US debt pile really outstripped the rate of foreign purchases of treasuries. That's why this line goes down here. But since 2023, that trend has reversed, and foreign investors have begun ramping up their purchases of US bonds. In fact, foreign ownership of US bonds reached an all-time high in July, reaching $9.2 trillion. There's an apparent contradiction here. If demand for US treasuries is increasing, then the dollar should be strengthening, but it isn't. The dollar is weakening, and not just against the euro. This is the US dollar index, or the DXY, which weighs the dollar against a basket of major foreign currencies. And it's quite clear that the dollar has been weakening since January 2025, which means that even given a record foreign ownership of US treasuries, there is still more selling pressure on the dollar than there is buying pressure, and there are several likely reasons for that. One key reason is that US economic policy uncertainty reached record highs earlier this year and remains elevated. Investors want clarity on economic policy for the same reason they might want to see a clear business plan before buying a stock. When policy uncertainty is high, which it has been for months, then investors get cold feet, and this could push them away from dollar-denominated assets. It's likely no coincidence that the divergence between rate differentials in the US dollar/euro pairing began in April, just when Trump announced the Liberation Day tariffs, blindsiding investors and trade negotiators around the world. So chronic economic uncertainty likely plays into it, but those tariffs do too. The wave of new levies on imports since January has brought the average US tariff rate from 2.5% to nearly 20%. In theory, tariffs should strengthen the dollar because they incentivize domestic companies to buy more American goods. But in reality, the opposite is happening. That's because lots of other countries have retaliated with their own hefty tariffs on the US, reducing foreign demand for American goods and US dollars. And all of this has weighed on US economic growth. In January of this year, the IMF projected that the US economy would grow by 2.7% in 2025. In July, they revised that down to 1.9%. By comparison, the European economy's growth projection remained stable at 1%. So even though the US economy is still growing faster than the European economy, it's the slowing momentum that could be raising concern. Here's another way of looking at it. US real GDP growth has been below average since Q3 2024 and is projected to remain well below that average until the end of 2027. That matters because the market is forward-looking. It sees that the ability of the US to grow its way out of its debt problem is diminishing, especially as its growth forecasts are revised down while Europe's remain stable. So all of this has important implications for the US and global economies and the US stock market going forward. For one thing, it signals that the world's confidence in the US bond market and the US dollar as safe havens is wavering. The risk-free asset is no longer seen as truly risk-free. It's long been said that the US dollar appreciates when the US economy is weak and when it's strong. This is called the dollar smile theory. When it's weak, investors tend to flee to safety, and that has long been US Treasuries and US dollars. And when it's strong, optimism often drives rallies in US equities. But this is a crisis of confidence in the US itself. For the first time, a major global risk is causing capital to flee from the dollar, not to it. The traditional playbook is being rewritten. Two scenarios to consider going forward. First scenario, these two lines keep diverging, and the dollar continues to weaken despite higher rates. A weaker dollar and higher tariffs both make imports more expensive, which fuels US inflation. The inflation rate has been ticking up over the past few months, and if that continues, it could force the Fed to hold or even raise rates. That would slow the economy and make the debt burden even heavier. This in turn could erode confidence even more, leading to an even weaker dollar. It's a doom loop. The other scenario is if the dollar strengthens to reflect the US rate advantage. In this scenario, the two lines would reconverge and begin to follow each other more closely again, resuming the old pattern. That would indicate that anxiety about the US debt burden has subsided and investors are willing to park their money in US cash assets again as the ultimate safe haven. The final takeaway is this: the market's most important question has shifted from what will the Fed do next to is US debt sustainable? This divergence is the market's answer. It's a warning sign about the US economy's long-term health and a signal to investors that the old playbook may no longer work. At Capital.com, we'll keep you updated with the latest market trends, including the state of the US dollar and other currencies. Hit like and subscribe to stay tuned. Thanks for watching.